All right, today we are digging into one of the wildest earnings reactions I've seen in a while. We're talking about Pioneer Power Solutions. It's a fantastic story of how the market can tell two completely different tales about the exact same company in less than 12 hours. And that's really the big question, isn't it? Right after their earnings call, the stock takes a dip. But by the next morning, it's absolutely rocketing higher. So what on earth happened? What did the market suddenly figure out in the middle of the night that it completely missed just hours before? Okay, let's just look at this because it's pretty stark. On the left, you've got the knee-jerk reaction right after the announcement, down 4%. Seems logical, but then on the right, the very next morning in the pre-market, it's up a staggering 45%. This wasn't some slow change of heart, This was a violent, whiplash-inducing reversal. So, to solve this mystery, we've got to look at what caused that initial dip in the first place. To really get what's going on, we need to put on our short-term investor hat for a second. Let's look at the headline numbers, the kind of stuff that probably spooked the algorithms and the quick-glance traders right out of the gate. First up, the bottom line, a loss of 12 cents per share. Now, believe it or not, this was actually better than what Wall Street expected. But here's the thing. For a lot of traders, a negative number is a negative number, period. It just screams not profitable, and that alone can trigger an immediate sell-off. Next up, you see a 23% drop in their backlog. And backlog is just a fancy word for confirmed future orders. It's supposed to tell you how much revenue is coming down the pipe. So when you see that number fall, even if it's because you were busy delivering on those orders, it can really look like the well is starting to run dry. It's a number that always gets a ton of scrutiny. And okay, this one's a biggie. The company's cash pile shrank by over $23 million in just 6 months. For a smaller company, that is a huge red flag. You see a number like that and you immediately start asking questions about their cash burn and, their financial stability. But where did that cash actually go? See, it wasn't just burned on keeping the lights on. The two biggest chunks were a nearly $17 million special dividend they paid out to shareholders and another $4 million in tax payments. And right there, that's our first big clue that maybe, just maybe, that initial negative story is missing some really important context. And then you have this. Right in the middle of the earnings call, with the market freaking out about the cash and the losses, the CEO, Nathan Mazurek, calls it an excellent quarter. That's a huge disconnect, right? And that's the pivot point. It tells us there's a whole other story buried underneath those headline numbers. So let's flip the script. This is where the market finally had its coffee, woke up, and started looking past those initial numbers and uncovered a much more compelling, forward-looking story about growth. And here's the first huge piece of that story. Revenue didn't just go up, it exploded. A 147% increase compared to the same time last year, hitting $8.4 million. Growth like that is almost impossible to ignore. It's a massive signal that whatever else is going on, people really, really want what they're selling. And the best part? This wasn't some fluke. It was all about execution. They delivered on a huge order for their eBoost mobile chargers to a major school district. They started shipping units for a brand new $10 million contract. And they even figured out how to make more profit on the later units they delivered. This shows they can land the big deals and actually deliver on them. I mean, just look at this chart. It really shows you how dramatic that growth is. They more than doubled their business in just 12 months. That's the kind of picture that makes investors stop, take a breath, and take a much, much closer look. Okay, this one's a little more in the weeds, but stick with me because it's super important. Their non-GAAP operating income. Think of it like this. It strips out a bunch of the accounting noise to show you if the core day-to-day business is actually making money. And what happened? It flipped from a loss last year to a profit this year. That tells you that underneath it all, the fundamental business is getting stronger and more efficient. But honestly, the real reason for that 45% surge wasn't just about the quarter they just had. No, it was about what's coming next. Investors started to realize that Pioneer's on the verge of opening up a massive new market with a totally new product. And this is it, HomeBoost. It's basically a private power plant for your house or your small business. It's not just an EV charger. It's a solution for resilient, reliable power, something that's becoming more and more critical every single day. This product just blows up their potential market way beyond just commercial EV fleets. And here is the absolute key. HomeBoost won't make them a dime in 2025. But the stock market is always looking ahead. The launch is right around the corner, and the company expects it to be a huge driver of their business in 2026. That 45% surge, that was investors pricing in the massive potential of this next chapter. So let's just pull back for a second and look at the big picture. The surge wasn't just about one quarter or one new product. It was about the market suddenly realizing that Pioneer is plugging itself in to some of the biggest, most powerful trends in our economy. I mean, just look at this list of who they're selling to. This is not a company with all its eggs in one basket. We're talking electric school buses, robo-taxis, government agencies, shipping ports. I mean, everybody is electrifying their fleets, and Pioneer is positioning itself to be right in the middle of all of it. And this slide really nails their two-pronged strategy. With eBoost, the whole game is about mobile EV charging. But with the new HomeBoost, the main sell is resilient power. It shows they're making a really smart move to diversify from being just a charging company to becoming a much broader and arguably more essential power solutions provider. And they have a clear plan to make it all really profitable. Management laid out a roadmap to basically double their gross margins from where they are today to over 30%. For an investor, that's music to your ears. It means this isn't just growth for growth's sake. There's a clear path to building a very profitable business. So let's bring it all home. Let's answer our first question. What in the world explains this wild ride? Well, it really all comes down to what you choose to focus on, the past or the future. And this is really why this matters. The initial dip, that was a reaction to backward-looking numbers, the accounting loss, the drop in cash, the shrinking backlog. But the surge, that was fueled by investors who dug a little deeper and found the forward-looking story, the incredible revenue growth, the major new contracts, and that game-changing new product just on the horizon. The market didn't change its mind. It just needed a few hours to read the whole report. And that really leaves us with this final thought. What are we looking at here? Is Pioneer just another small industrial company, with lunky profits that go up and down with big orders? Or are we watching the very early stages of a company that's building the foundation for a future where power is more distributed, more resilient, and all electric? Well, the market's wild 12-hour ride seems to suggest it's starting to bet on the latter.